Hi, my name's Bruce Lusby and I'm a mortgage broker with Premiere Mortgage. I've been a mortgage broker for 10 years and I love helping people through the mortgage financing process and helping them get into a new home. Sometimes credit can be a bit of a mystery to clients and there are some misconceptions, but there are 5 basic things that go into what a credit score will be evaluated at and what goes into the strength of a credit score. The first is credit history, and the most important, it accounts for 35% of your credit score. The next is credit utilization, and that accounts for 30% of your credit score. The next would be the length of time that goes into a credit account. The fourth element to a credit score is bad debt. So that would be any debts that are sent to a collection agency, or even worse, a bankruptcy or consumer proposal, and that accounts for 10% of your credit score. And the fifth and final aspect to your credit would be credit-seeking behavior. So that accounts for 10% of your credit score, and that's anyone who's searching for credit and applying for a lot of credit all at once. So applying for 5 or 6 credit cards in a credit-seeking behavior. So as I mentioned, the first and most important aspect of credit is your credit history. So as again takes into 35% of your credit score, so it's very important. That looks at your credit history for the past 7 years. So any late payments that you've had will affect that score, that portion of your score. And basically, if you have a late payment on your credit card or line of credit or car loan, those points, 35% of your points will go away. And then you need to get back on track, get your payments on time again, and over time, those points will come back towards your credit score. So for lenders, it is important for them to look at the history because in their mind, past performance is the strong indication of what future performance is going to be. So if you make late payments on your credit card account, they assume that you're going to make late payments in the future. So that's why the credit history is very important. So the next important aspect is credit utilization. So credit utilization is important. It accounts for 30% of your credit score. It basically looks at how much credit you have and how you manage that credit. So it's important to know that most lenders are going to want to see that you have a minimum of 2 trade lines, so 2 credit cards, for example, or a credit card and a line of credit, and that you're managing that credit properly. So what's your limit and what's the balance on those debt accounts? And so one common misconception is that clients will have a credit card that has a limit of, say, $10,000, but their balance might be $9,000, and they think everything's okay, when in fact, it hurts your score to have a credit balance that is above 50% of the limit. So if you've got a credit card that's got a $10,000 limit, keep your balance below $5,000. If you've got a line of credit that's got a $10,000 limit, keep your balance below $5,000. Any balances below $5,000 will help your credit score. Any balances above 50% of the credit limit will hurt your credit score. And then any balances over your credit limit really hurt your credit score. So it's important to know to manage your credit properly, to keep your credit balances low and at least below 50% of the limit. 2 key components with that would be that if your credit card company reaches out to you and says, we'd like to increase your credit limit, take them up on their offer and increase your credit limit. Just don't use all that credit. Again, keep the balance below 50%. But if the credit limit goes up, great. So the third aspect of how your credit score is allocated would be the length of time that you have established credit accounts. So not many people are aware of this, but the relationship you have with your card and the length of time you have with your credit card or line of credit allocates for a certain amount of points, is 15% of the points towards your credit score. So it's important not to cancel an old credit card. If you've got an established relationship with that card, I always recommend to clients that they find a card they like, and trust, and they use it and stick with it. If you jump from one credit card to another every year for a card that has a better point program, for example, or incentives, you're going to lose those points towards your credit each time that you close that account and start to reestablish a new account. With regards to the length of time that you have a card, some people may have 2 or 3 credit cards, but they only use one. If you've got a card that you use, great, and you have other cards that are just sitting collecting dust, what I would recommend is that you use that card that is sitting in the drawer once a year, for example, because if you don't use that card, it can become a dormant credit account, and therefore it's not helping your credit score at all. It's just dormant. So if you use it, dust it off once a year, use it and pay it off right away, that will reestablish the credit and make sure that you're getting the benefit of having that credit account. The fourth is bad debt. It accounts for 10% of your credit score. This is bad debt. It's having a bankruptcy, having a consumer proposal, or having bad debt that's been sent to a collection agencies. So just by managing your credit properly and not having to go through any of those unfortunate situations, you can gain up to 10% towards your credit score. The fifth and final last piece towards how your credit score is allocated is credit-seeking behavior. It accounts for 10% of your credit score. And this is basically for a client that may be applying for a whole bunch of different credit lines, credit cards, all in a short period of time. And the rationale behind that is that the lenders believe that if someone's in a credit-seeking behavior, that they're in financial distress. So if you have too many credit card applications all at once, it's going to hurt your credit score. So your credit score can be hurt, to summarize, simply with late payments, having credit balances that are above 50% of their limit, even worse, having credit that's over your limit on your card or your line of credit, and then a very unfortunate situation with a bankruptcy, consumer proposal, or having debt sent to a collection agency, as well as jumping around from one credit card to another. So a credit score can affect your housing situation and your mortgage application in several ways. One is that, first of all, it's the first and most important hurdle to get over to qualify for a mortgage. If you don't have an acceptable, satisfactory credit score, you simply can't qualify for a mortgage. A satisfactory minimum credit score for an insurable mortgage is 600. With some lenders it's 620, with other lenders it's 650. So the important part there for a lot of first-time home buyers is for down payment. If you don't have an acceptable credit score, you don't have the ability to put the minimum 5% down, or 10% down, or 15% down, or to be able to have the option to borrow your down payment funds, or tap into the Nova Scotia Down Payment Assistance Program. You only have the option to put 20% down or more. So with that in mind, it does reduce all your options for a first-time home buyer, and can eliminate the option to buy if you don't have 20% down. Plus, it can cost you more. So 2 factors there. One being that when you have a lower credit score, you may not qualify for, a lot of the lenders have unpublished rate specials or sale rates, and the lender would have particular criteria that you need to have a minimum credit score to qualify for that lower sale rate. So potentially you'll lose out on interest savings for a lower rate. And the other fact is that if you don't qualify for an A lending mortgage, to be able to put 5% down or 10% down, and you need to qualify for a B lending mortgage because your credit score isn't high enough for an A lending mortgage. A B lending mortgage is going to cost you more for a higher interest rate. The interest rate for a B lending mortgage is typically 1% to 2% higher than a regular normal mortgage. Plus, you're going to have to pay a 1% lender fee, so that's going to cost you a little extra. And plus, you're going to have to put down at least 20% and sometimes more. So when a couple is applying for a mortgage, Lenders will want both halves of the couple to have a satisfactory, acceptable credit score to be able to use their income towards the total qualifying income on the mortgage application. If they don't, it limits how much we can get the client qualified for, because maybe we can only use one of their incomes as opposed to both of their incomes. So half of the income towards the total qualifying income can limit what the client is able to qualify for. As well, some lenders, if the client doesn't have an acceptable credit score, they won't allow them to be on the mortgage application at all. Not just that we can't count their income, but they're not allowed to be on the mortgage application. So therefore, if they can't be on the application, they can't be on the deed to the property as well, which can be an inconvenience for the couple and can also create a situation where they can't afford the home they want to buy. They can only afford a home that's under what is in their search criteria. And a last point with regards to credit is that, for example, when a couple, let's just say they're new to Canada and they're coming in and establishing credit in Canada for the first time, it's very important that both halves of the couple establish credit, that they have credit cards in each of their names, so they have a credit account in each of their names, and both of them are establishing credit and growing a credit score. Whereas if it's only in one name and the second credit card is only just a card in their name but not a credit card account in their name, then they're not establishing a credit history and a credit score. So it's important that both have an established credit score and history, so that eventually when they want to buy a home, they both have an acceptable, satisfactory credit score, and we can use both of their incomes toward the total qualifying income on the purchase. Again, my name's Bruce Lusby from Premiere Mortgage. Thank you for your time today. If you have any questions, I'm happy to help. You can reach out to me directly, or you can have your realtor introduce me and connect me via email or phone.